That arbitrage opportunity is going to continue for as long as it takes for Bitcoin to fully monetize, which I think is at least 20% of global asset value. Basically, I think there's a massive reservoir worth of capital stuck behind a dam. It's going to flow into this undervalued area through a crack in the dam that is these Bitcoin treasury companies. That system will try to seek equilibrium again. That means a huge amount of capital flowing into Bitcoin treasury companies because they offer better value than traditional equities at this point in time. It's a function of the world certainly not being aware of how Bitcoin treasury companies work. There's probably 100,000 people in the world who have really wrapped their head around that. But I think that these vehicles become the single biggest cohort of bidders for Bitcoin over the next 20 years. They will accumulate a huge proportion of all Bitcoin. I think half of all Bitcoin will end up in Bitcoin treasury companies because demand will be so great as global capital realizes that this is where value actually is.
You buy Bitcoin, you hold it for more than 4 years, Joe. That's my advice to everybody.
Fair to say you simply flooded the system with money?
Yes, we did. That's another way to think about it.
Where does it come from? Do you just print it?
We print it digitally.
I'm very bullish on the long-term viability of Bitcoin.
I was going to say, did that surprise you?
That surprised me how much that's gone up.
Hey, Internet, welcome back to another episode of New Foundations, the podcast brought to you by Acropolis, the Bitcoin treasury company. As always, I'm in the studio with my co-host, co-founder, and CEO of Acropolis, Chase Palmieri. And this week, we're joined by Jesse Meyers. Very excited to have Jesse on the show this week. He's currently implementing Bitcoin treasury strategies within the UTXO management portfolio. Previously, he co-founded Onramp, ran a Bitcoin-focused family office, spent some time at Bain & Co., and also got his MBA from Stanford. He's also known for his once-in-a-species Bitcoin thought leadership, which includes Why the Yuppie Elite Dismiss Bitcoin and the ubiquitous global asset value chart famously used by Michael Saylor. Jesse, welcome to the show.
Thank you for that very nice intro. Happy to be here with you guys.
Yeah, I've been following you for a long time and very happy that you're on our side. You're on Team Bitcoin. Let's go ahead and start with getting into the meat of the questions because we like to ask questions that are pretty unique and not just typical things that you answer over and over. So for listeners who may not be aware, can you explain why it makes sense for these Bitcoin treasury companies to have an underlying operating business? Because we sometimes hear folks ask, strategy, why wouldn't you just ditch the operating business and focus on capital markets instead?
Yeah, very interesting question. And there sort of are two perspectives on it, right? There's the perspective of it doesn't matter, and there's the perspective of it does matter. And I think both sides have an argument depending on what kind of market you're in at that moment in time. I think having an operating business is helpful in a bear market in particular, and not having an operating business could be an advantage in a bull market, just in terms of not taking management's time mostly. I think overall, it's globally, I think it makes sense to have an operating business, one that generates modest profits ideally, or at least isn't a drag. Because really there's kind of a regulatory benefit that's pretty consistent across the world of regulators. You know, the Bitcoin treasury strategy is a brand new thing. Regulators are still trying to wrap their head around, you know, what is this? Is this a type of different business? But, you know, for Smarter Web that I'm involved in the you know, it's a web development business that's been running for 15 years in the UK, profitable every year for 15 years, a small business, and recently went public. And, you know, it part of that going public was making the choice of we're going to use Bitcoin as our primary treasury asset and try to add Bitcoin to the treasury over time to strengthen the business's balance sheet. And if you're a regulator, that's fair, right? Like, okay, you're a business that's been operating for 15 years and you're choosing to hold Bitcoin. Like maybe you would choose to hold gold. Maybe you would choose to hold US dollars instead of pounds. That's a valid choice that any company can make as part of their operations. And so I think that's very helpful to have that sort of regulatory clarity. And then there's the additional benefit of it can generate operating cash flows, which are helpful for paying the bills and paying salaries, and that's particularly helpful in a bear market for making it so the Bitcoin Treasury company doesn't need to draw down its Bitcoin because you're paying the bills with cash flows from the operating business. And then, of course, with Strategy, there's the additional benefit they've enjoyed over time of they spit off a lot of cash flows and they can service their debt. Historically, their convertible debt that they were getting at very low rates, but they had a fair bit of cash flow that they could easily cover that with. So those are kind of the advantages.
Yeah, and I think many OG Bitcoiners, which I would obviously throw you in there, so this is why this question's for you, but I think many OG Bitcoiners expected that the equity and fixed income investors would eventually see the bright orange light and decide to stop buying stocks and bonds and instead just buy cold storage Bitcoin. But instead, what we seem to be seeing here is that these Bitcoin-backed equities and bonds, these Bitcoin-backed fixed income securities from these Bitcoin treasury companies are actually attracting a lot of that capital. And I'm curious, do you think that this is just a stepping stone until, these fund mandates change to start accepting spot Bitcoin and they learn to tolerate the volatility and they so don't need this kind of softened volatility security? Or will these securitized Bitcoin vehicles just continue to be the main point of absorption of these large capital pools? And I guess to throw in there, I've heard you say that what's great about these Bitcoin treasury companies and their securities is that they can be designed to meet the capital where it's at. So does the capital need to be met where it's at long term, or do they eventually just start looking at spot Bitcoin?
Yeah, I think it needs to be met long term. I sort of the latter of the two scenarios you laid out there. I think that the Bitcoin treasury companies will be the preferred vehicle by which global capital gets exposure to Bitcoin, and I think that's just a reality of TradFi and how things have been constructed. I I believe in Saylor's version of the future, partly because his model is uses my model as a starting point and builds on it from there. So we're aligned. But I think that his estimate is that Bitcoin will grow at 50% a year, and then CAGR, and that will drop to 20% a year over time, and continue growing at 20% a year. I guess he's recently updated that, but that was a year ago, and averaging 29% CAGR. So I think that what Bitcoin treasury companies offer to global capital is, we will buy Bitcoin and expect 29% CAGR over the next 2 decades. And we will be willing to pay you whatever you're looking for in order to access that capital. And so for the bond market, that's we'll pay you 8 to 10%. And risk adjusted, that's going to be better than anything else you're going to get out there, because 10-year treasuries are 4.5%. And then you can add risk from there, but risk adjusted, you're not going to get better than single digit, mid-single digit yields in fixed income. But because of Bitcoin's 29% CAGR, you can actually, I think, offer 10% for that kind of capital, and use that capital to buy Bitcoin. So it becomes mutually beneficial to both sides there, obviously. And I think that's meeting capital where it's at. These fixed income mandates are I think, deeply embedded. I think it's a cultural, systemic thing that will take multiple generations for us to shift fully away from like a 60-40 portfolio construct, and towards like Bitcoin based savings technology approach to portfolio construction. But even in that scenario, in that 20 plus year future, scenario, I think the one thing that Bitcoin doesn't offer to holders is yield, right? And that's fine because it has fixed supply and it offers deflation because obviously the global economy will grow and Bitcoin supply won't grow, so your purchasing power for holding Bitcoin will grow over time, even in the past 2140 where there's no more increasing scarcity of new supply issuance. But I think that there's always going to be demand for yield, and that can be done poorly, right? With like BlockFi or Celsius, and a number of other things over the last 16 years, where that doesn't work. But what we're seeing with Bitcoin treasury companies is a very fundamentally based approach to generating Bitcoin yield, and that's arbitraging with valuations in equities markets, and now, as Saylor's doing, tapping into the bond market with convertible debt, and then now preferred equity vehicles that are wrapping up debt in new equity instruments. And that our arbitrage opportunity is going to continue for as long as it takes for Bitcoin to fully monetize in the world, right? Like to go to its end state, which I think is at least 20% of global asset value. And Saylor has said as much as 50% of global asset value. I think that's fair. I think we're going, over the next few decades to somewhere in that region. And so long as that process is underway, there will be opportunities for public companies to utilize capital market tools to provide Bitcoin yield by helping to facilitate the flow of capital from these other asset buckets into Bitcoin by going through these Bitcoin treasury companies. And so that's the playbook at a 30,000 foot view, and the fundamentals will remain there so long as Bitcoin has not fully monetized to continue offering Bitcoin yield to shareholders. And so, I think that's a long game play we're only just beginning.
And I think TradFi has started to understand why a company would be doing this arbitrage in the capital markets to acquire Bitcoin, because at the end of the day, even TradFi can understand that you want to borrow the debasing dollar to acquire an appreciating asset. But I think TradFi still struggles to understand why an individual investor would want to become a shareholder in a Bitcoin treasury company as opposed to buying spot Bitcoin, and why these capital pools are being drawn into these securitized Bitcoin equities. So let me kind of pose a summary, and then you feel free to pick it apart. But on one side of this trade, I see individual shareholders who are getting access to leverage at better terms than they'd be able to get individually. And then on the other side of the trade, you have pools of capital that want softened exposure to Bitcoin through a security, whether because of mandate or because they don't necessarily want to have to custody spot Bitcoin. So better leverage terms for individual Bitcoiners who want Bitcoin exposure, and softened Bitcoin exposure for these pools of capital without having to worry about custodying spot Bitcoin. Is that how you see it, or is there a lot more to it than that?
No, I think that's a pretty good framing. In the softened exposure bucket, I think there's kind of two worlds there. There are people who want Bitcoin exposure without the trouble of setting up their own keys and taking on self-custody. And so your options are like an ETF, or you could, instead of an ETF, go buy Strategy because they've been delivering a certain amount of yield every year, Bitcoin yield every year. And so I think that's one version of softened exposure. It's, I want Bitcoin, but I'm kind of lazy, or I don't want to take on all the responsibility that comes with doing spot Bitcoin with best practices. There's also, on the total other side of things, there's a lot of capital that doesn't want Bitcoin, but they want high fiat yields, and the 10% fixed income scenario, where they don't understand how it works. They don't really get it, but they know that that strategy is highly over collateralized and they're going to be good for it, so they can service this very small debt burden that they have in for example, Strife, where the terms are very favorable to the investor and they know that they're going to get paid out because of it. So I think those are two pretty different cohorts of people. And yeah, and then of course there's the cohort that understands the concept of Bitcoin yield here, and what's happening with tapping into capital markets. As you put it well, of like, as an individual, I would love to go raise a bunch of debt to buy Bitcoin, at a low interest rate and then pay it back in 5 years. Like, I would love to do that, but I can't do that because nobody will offer that to me. But if you're a public company, you can get that. If you have a good enough balance sheet, you can find those arrangements. And so there's a good cohort of investors who can't do it personally, can't tap into capital market tools as an individual, but want that as part of their portfolio, and so they're giving their capital to a company to do it on their behalf.
We asked Alexander Lazay, he's the head of the blockchain group now known as Capital B, which if everyone keeps changing their names, it's going to be pretty hard to keep up with, and it's always going to be also or otherwise known as the blockchain group. But we asked him how he would allocate 10 million if he was the CEO of a Bitcoin treasury company that didn't hold any Bitcoin yet. And he said he would lump sum the 10 million because regardless of if there's some fluctuations in price, you kind of just want to lock in those sats. Would you agree, or do you see value in ramping up buys?
Yeah, I think it depends. I think if you're in the US, for example, where it has the most developed Bitcoin treasury company landscape, and strategy has already locked up, the winning position there. I think in that context, you should just lump sum it and, get as much as you can and try to grow from there. I think, well, actually, I mean, I could see that being a fine way to go. I think in a country that doesn't yet have a leadership position, leading Bitcoin treasury company, I very much like the approach of stage out your buys to help build a track record and grow your Bitcoin yield over time. That's what Smarter Web did, and for a variety of reasons, logistics being one of them. And I think it proved very helpful to accelerating the development of a community and a retail base that gets it, because there have been more announcements than if you just were to lump sum it all up front. And that builds a track record of great, evidence of this is what we're doing and have continued to execute on. And you can sort of paint a picture of where this is going a little bit better if you have more data points. And so I think there's a ton of value to that. And there's like a path dependent community building element for growing from nothing to a market leading, a particular capital market leading Bitcoin treasury company, which I think we've seen MetaPlanet do. Like you have to build a track record and build that retail investor base, to build that community around this is what we do and we're going to keep doing it. And that's path dependent. You have to start small. You have to deliver. You have to execute on an intended plan and show those results and let the market run their own numbers and say, wow, this is working. And we can see that it is likely to keep working, and, become supportive of that. And so I think people miss that there's a ton of value in that, building the track record and building the community to help you have the infrastructure and support for where you're trying to go.
On the other end of the spectrum, you have super large players like 21 Capital. Do you think they're making a mistake starting so big?
Yeah, I think on a different podcast I said mistake. And if it's not a mistake, it's in that direction, I think. I think that's because, if you're going to have an MNAV premium, you need to have a track record of growing Bitcoin per share over time, in order for for investors to say, I'm willing to pay more now than the NAV value of the company, because we've seen how they've grown Bitcoin per share over time, and you're buying in on a continuation of that execution. Versus if you come in lump sum upfront, make a huge buy, that's great, but then how do you sustain an MNAV premium? Because to do that, you have to follow that up with you have to buy twice as much over the next 6 months. And there's no track record of having done that. There's no reason to necessarily believe that that's going to happen. And so I think that puts a company like 21 in a tough spot where, great, you have a lot of Bitcoin and you'll trade at 1x MNAV, but why do you deserve a 3x MNAV? And who's going to be willing to pay that? And maybe they find a way to make that compelling case to investors, but I think what MetaPlanet has shown is that the best way, or perhaps the most straightforward way to show that to investors, is look at our body of work. Look at how we execute, how we've grown Bitcoin per share over time. And that's why you might be willing to pay a 3x or more premium to get in now.
Yeah, I think that's right, Jesse. You really do need to show a track record of some kind. Now, I think 21 Capital might argue that Jack Mallers has his own track record and Tether have their own track record. And so maybe they're banking on that being enough to attract, especially the retail investors in the space. And maybe it is, but I tend to agree, if this really comes down to an increase in Bitcoin per share, Bitcoin yield, Bitcoin torque, however you want to think about it, and proven execution against that vision over a period of time, so that it becomes a pattern, a trend, and something that you can line plot out into the future, then I do think that perhaps they are blowing their load a little too early, if you know what I mean. One thing we're going to get into now is obviously going a little bit deeper on MNAV and smarter web in particular, but just to lay this case out. So I think a lot of folks who are following this space think that if MNAV goes to 1, that a company can no longer be accreting Bitcoin per share. But that's not actually the case, because there's still an operating company that can still take out intelligent leverage opportunistically. So how would you explain that even if a company gets to 1 MNAV, that they can still be adding to Bitcoin per share?
Yeah, luckily it's something I haven't had to spend a ton of my time on at Smarter Web, because we enjoy a decent MNAV premium, which makes our bread and butter accretive dilution, new equity issuance. But there are other levers you can explore and evaluate if you're in a 1x MNAV condition. At the most basic level, that's when debt might become more attractive. If you don't have any debt, SmarterWeb has 0 debt on its balance sheet. If you don't have any debt, you could take on 20% debt and without it really being a existential concern at all. And find debt terms that are very low interest, if not 0% interest. And that's particularly possible with convertible notes. So I guess let's explore that one. If you're at a 1x MNAV, but you've had a track record of volatility, then of any kind of any reasonable amount of volatility, you can offer convertible notes that have a conversion option that would be very attractive to an investor. So Black-Scholes option pricing, with any sort of volatility in your stock, that becomes very valuable. The value of that option is high. And so that's why that investor might be interested in paying 0% or receiving 0% interest because it comes with a conversion option that's very valuable to them. Even if, they may or may not end up using it based on how things play out, but upfront, the option value is very high. So that's a scenario where that would be a very attractive thing to explore. How do we raise a bunch of fiat by issuing convertible notes to buy Bitcoin with and the convertible note has 0% interest and a conversion premium, ideally, but a conversion option for the investor to that gives them their value and why they would give you dollars up front. And just like that, you've managed to increase your Bitcoin holdings, let's say 20%, I guess, in that condition. And now you're starting to generate momentum again right there. So that'd be one lever. You can also sell options, explore that world, which MetaPlanet has done as part of generating positive operating profits. They've done that. I forget their exact structure for what they sell. I guess covered calls probably, and that's operating income that you can then use to buy more Bitcoin with, and suddenly you're generating a yield, and the market should over time return you to a positive MNAV above 1. So yeah, those are just two of the possible structures you could explore, but there are ways to continue harnessing the diverging reality of Bitcoin and fiat in terms of their purchasing power, particularly if you extend out the time duration of the obligations you're taking on.
Every business will hold Bitcoin. Some already do. Others are developing a plan. Acropolis is how smart companies take action today. Built on multi-institution custody, Acropolis delivers a turnkey Bitcoin treasury solution designed specifically for businesses. Here's why that matters. Multi-institution custody is the breakthrough that unlocks the corporate adoption of Bitcoin. It eliminates the need for employees to hold cryptographic material and removes reliance on any single custodian. Instead, Bitcoin is secured using a 2 of 3 multi-signature quorum, where each key is held by a separate, regulated institution. No single party can move funds on their own, eliminating single points of failure and greatly reducing risk. We act as an extension of your treasury team, managing institutional-grade custody, insurance, continuity planning, and strategic advisory, so your company can adopt Bitcoin confidently and securely. If your team has been sitting on the sidelines, unsure of how to get started, or worried about getting it wrong, this is your signal. Visit acropolistreasury.com and schedule a consultation. Bitcoin is reshaping corporate finance. Don't get left behind. SmarterWeb is averaging around 5 Bitcoin purchases per month. What is the bottleneck to making those purchases, or perhaps really just announcements of purchases? But what's the bottleneck to making that more frequent?
Yeah, I think we've been doing it about as frequently as you can. There's a certain amount in a public company. There's a certain amount of process that has to happen for every announcement. It doesn't take a ton of time, but you gotta button up everything and take a snapshot at a point in time and make sure all the numbers are right, and then go through the process of announcing that to the market. So there's a bottleneck there, or I guess a rate limiter there. Of you don't want to do that every day, but you can do that once or twice a week. I think the reality is that you want to make your Bitcoin buys meaningful, and as that track record grows, what meaningful means gets bigger. And so that's just a reality of if you hold 1 Bitcoin on your balance sheet and you buy a second Bitcoin, that's a big deal. That's really good. But if you hold 1,600 Bitcoin on your balance sheet like SmarterWeb does now, 1 Bitcoin sure isn't going to do anything. So you have to add quite a bit more. So and that obviously takes capital, and raising capital is the other sort of reality of we have 2 ways to raise capital at the moment. We do private placement rounds, our accelerated book builds, and then we have an ATM style instrument that sells shares directly into the market when certain conditions are met. You only want to do it on up days. And those two things, well, one is humming in the background, and then the other is, a process that takes a couple weeks to go through. So those are kind of the things that are you're balancing as you're trying to raise capital, and it's a process that takes time. And I think that investors in Bitcoin treasury companies kind of can sense it, but I think there's a very real operational reality on the inside of how urgently, how quickly management is executing on the tasks necessary to go through a capital raise. And that's one of the things that has, I think, set Smarter Web apart is the pace at which Andrew, the CEO, gets shit done. Really, I think that actually comes back to what he's been running for the last 15 years is a business that has 250 web design clients, where they just have to get shit done, to help service all those clients. So the culture in the company is like get it done now, like or tomorrow. And I think that's kind of different from how a lot of business is done. And I think it's very conducive to raising capital quickly and being able to deploy that into Bitcoin quickly, which is, I think, a big part of why Smarter Web's rate of Bitcoin accumulation has been the fastest in the world this year.
Yeah, another thing that sets Smarter Web apart is just the market that it's operating in, right? Because we see that UK investors can't actually put Bitcoin in their retirement accounts, and there's historically been limited ways for UK investors to get Bitcoin exposure. You could also argue that that's why we see such a high MNAV for MetaPlanet, because there's similar limitations in the Japanese market. I'm curious if you could take all of what Smarter Web has done and you could just pick up the company and drop it into another jurisdiction, another market, is there another market that you think would justify an even higher MNAV if it had done all the same things? Is there a market out there that has even more restrictions when it comes to investors getting Bitcoin exposure?
Yeah, but it's funny that, I wouldn't drop Smarter Web into any other place because I think it's perfectly suited to the UK market. And that's, it's a very authentic story. It's a British business that's been running for 15 years, led by, a UK guy born and raised in Bristol. So I think it's perfect for that. And I think it really resonates with retail investors in the UK for a lot of those reasons. There is one market that hasn't fully been cracked yet, and that's China, Greater China. And I think Hong Kong is the way that will eventually be won, because there's Hong Kong's the only place in the world where you can, as far as I'm aware, that you can access Western capital and also access mainland China capital through a Hong Kong exchange listed company. They have programs in place to do that. And that's so Greater China has probably more pent up demand for Bitcoin than anywhere else on Earth that is currently unmet, and I think will be a pretty insane tailwind whenever that really takes shape. But there's sort of regulatory challenges there.
I like that answer because it would have been the same one that I had, actually. I studied abroad in China. I lived in Shanghai, and both Shanghai and the Hong Kong Stock Exchange are top 10 capital markets. And if you understand the dynamics of the Chinese Communist Party and the freedom and the way that they store capital and do payments over there, it's definitely the most untapped market in terms of Bitcoin. So
And maybe another one here for SmarterWeb, which will kind of tie into a deeper discussion around PE multiples in traditional markets. Right now, SmarterWeb, and correct me if any of these numbers are wrong, but this was the last time I checked, SmarterWeb has 35 days to cover, whereas NVIDIA is earning $77 billion a year. And so to reach their $4 trillion valuation would take 52 years of earnings. So we've got 35 days to cover with SmarterWeb and 52 years of earnings with NVIDIA. It seems to me that the market is mispricing something. So I'm curious, do you think it's that Bitcoin treasury companies are going to end up with higher MNAVs or what you might now, thanks to the accounting changes, call PE ratios or PE multiples? And traditional operating companies like NVIDIA are going to have their PE multiples come down? Or do they meet somewhere in the middle? How do you see this massive discrepancy in how these different companies are being priced, especially in regards to their earnings?
Yeah, this was the exact topic of the report we put out last week for SmarterWeb, introducing a new metric called the PBID ratio, which is it's designed to try to create a direct comparison to PE ratios. So in this case, price to Bitcoin yield delivered. And the report that I put together tries to lay out how, in traditional equities, the path to value generation is through annual profits. So it's through your income statement. And that's how the PE ratio is helpful, is a shorthand for, okay, based on the current value of the company and the most recent profits, how many years of profit is it going to take before I've made back my investment? And PE ratios right now are 52 for NVIDIA, and in the 30s for all the top 10 largest public companies in the world. So that's a long time. That's ridiculous, and that's kind of flies in the face of value investing as a concept, really. And in contrast, you have these Bitcoin treasury companies that, if you create the right formula, the PBID ratio formula, to isolate Bitcoin yield delivered and project that on a recent period, so that can be a week, a month, a quarter, a year, and project that forward, how many years would it take to, at that rate of Bitcoin yield delivery, to grow into the MNAV? And for SmarterWeb, as of that report, is 0.09 years, so 1 month, 35 days, to grow into, based on our most recent performance of Bitcoin yield delivery over the last week or 30 days, actually has been the same annualized rate, so, which is ridiculous, right? So if you understand and believe in that as a valid way to deliver shareholder value, right? So instead of income statement profits, instead of that, you're offering Bitcoin treasury asset growth in Bitcoin per share by using capital markets to accretively add to that treasury in a per share basis. So income statement value generation versus balance sheet value generation. And the point of the report is to highlight that if you're okay with that alternative approach to delivering shareholder value, these things may be totally mispriced relative to traditional equity valuations. And I think that's, so, I'm of two minds here, because Lynn Alden pointed out to me when I put out that report that a problem here is that, if you're basing things off of Bitcoin yield, and MNAV is an important input into that, then it's recursive, and you have a problem if you're proposing that the right equilibrium is that MNAVs should be way higher, but then it becomes way more attractive to accretively dilute and way easier to, and so it would in theory accelerate that and justifying even higher MNAV. So there's potentially a math problem in there. But my point back to her was that I think that there is a massive disequilibrium right now between capital stuck in equities at overvalued PE ratios. And that's just the price of admission. You just have to pay that if you want to park your capital in something that's not dollars or bonds. You just have to pay that high PE. But there's a huge amount of capital seeking value and it's not really finding it, right? You're just treading water because you're parked in the place that's going to rise with M2, which is global equities. But there's a ton of capital that would like to find value, and then here is this alternative way to create value for shareholders that I think is deeply undervalued. And I think there's I think there's a massive reservoir worth of capital stuck behind a dam, and it's going to flow into this undervalued area through a crack in the dam that is these Bitcoin treasury companies. So I think that will that system will try to seek equilibrium again. And I think that means a huge amount of capital flowing into Bitcoin treasury companies because they offer better value, in my opinion, than traditional equities at this point in time. And at the moment, it's a function of the world certainly not being aware of how Bitcoin treasury companies work and not having contemplated the concept of accretive dilution or the concept of Bitcoin yield generation and growing into your MNAV. So, I think there's probably 100,000 people in the world who have really wrapped their head around that. And I think that will grow over time as MetaPlanet continues to do what it has done. And I think there are more MetaPlanets popping up that will be leaders in their specific capital markets. I think there will be there's a winner take most reality emerging here in each capital market. And SmarterWeb at the moment is the leader in the UK and hopes to follow that same sort of path that MetaPlanet has been on for the last 15 months. And I think that's going to happen in every significant capital market in the world. And so investors are going to have to keep watching MetaPlanet style success happening in different pockets of the world. And we'll have to keep trying to figure out what is going on here and should I allocate to it.
Well, yeah, even if we look at the company in the space that has the longest track record and is the most well-known amongst Wall Street, which is Strategy, they're trading at below a 2x MNAV when if you believe that Bitcoin will go up over time and you believe that Strategy will be able to acquire more Bitcoin over time, it should almost have a compounding expansion to its PE multiple, especially now that because of the FASB changes and they're about to report at the end of this month for their quarterly earnings, this is all going to be treated as earnings. So this is it is now comparable in a PE kind of comparative way. It just seems wild to say, okay, this company has the most Bitcoin. They are accruing the most Bitcoin over time, yet we're only going to value them at what they're valued at today, plus a little.
Yeah, I totally agree. I mean, in that PBID analysis we put out, we focused on 3 companies: in Strategy, MetaPlanet, and SmarterWeb. SmarterWeb's PBID is 0.09, so 1 month. PBID is in years. MetaPlanet's was 0.4, so half a year almost. And Strategies was just under 2 years. And I think Strategy is a pretty safe going concern. They're huge, 600,000 Bitcoin, highly over collateralized, very, in my opinion, very low risk, right? And they continue to deliver. I mean, they're already at 20% Bitcoin yield year to date. So for a little over half a year, 20%. And so, if you, and they're trading, their MNAV is not very high. So if you factor those all into the PBID, it comes out to just under 2 years to grow into the premium you're paying up front, which is an incredible value proposition. I mean, talk about if you're having to wait 30 years to get your, cumulative profits equal to your investment today versus waiting 2 years, and then anything beyond that 2-year wait is just pure upside. That's a ridiculously attractive value proposition. So I think that highlights how, as a sector, as an industry, Bitcoin treasury companies are not understood yet. And I think it's financial engineering that is all about arbitraging the overvalued realities of equities and the bond market, and the undervalued and very real performance properties of Bitcoin, and helping capital flow from one state to a more attractive state, right? And as a whole, this industry is not understood. Will continue to be better understood as people just become more familiar with the math of it, and I think that and then that becomes a tailwind for strategy to keep doing what they're doing. I mean, you could very well argue that strategy should be trading at a 10 or 20x MNAV, which then only makes it that much easier for strategy to issue more shares and buy more Bitcoin and execute on that whole plan. So people talk about like, how is hyper Bitcoinization going to happen? This is, I think, going to be, it's not like a magic solution. It's not a silver bullet, but I think that these vehicles become the single biggest cohort of bidders for Bitcoin over the next 20 years. And I think they will accumulate a huge proportion of all Bitcoin. Like, I think half of all Bitcoin will end up in Bitcoin treasury companies, because the tailwinds of demand will be so great as global capital realizes that this is where value actually is in the investable landscape. And that will provide the fuel necessary to keep running this playbook until global capital has shifted from equities and the bond market and reestablish equilibrium in Bitcoin.
The three of us have established and agree that there's a huge arbitrage here and that the Bitcoin treasury sector itself is undervalued. But for the rest of the general market, which I believe is trading at an average of 17 price to earnings ratio, what happens? Do they die? Do they shrink? Do they stay at the value that they're at today, and the Bitcoin square per se just becomes bigger and the total global asset landscape has a higher market cap? Or what does the capitulation, I guess, look like in the equity market?
Yeah, so this is, I guess, the core exercise of the Bitcoin's Full Potential Valuation article that I put out that Saylor liked and kind of adopted it as the basis for his long-term valuation model for Bitcoin. And the core of that is that there's a lot of capital sitting in all these different buckets, but a good chunk of it is just looking for the best store of value place for it to sit and propagate into the future, without losing purchasing power. And Bitcoin offers, a better solution there than anything else. And so over time, you'd expect to see a migration of that capital into Bitcoin. Said a different way, each of those asset buckets has a monetary premium, has value sitting there that doesn't really want, like, for example, in the case of real estate, there's capital there that isn't using real estate to live in, but it's using real estate as a store of value, right? To just propagate value through time. And as that capital learns that there's a better place to park your value for the long term, where that value is going to grow in purchasing power rather than just tread water, that capital will migrate into Bitcoin, and that'll deflate each of these buckets on a relative basis. You'll have value exiting real estate, exiting equities, and exiting the bond market, and seeking Bitcoin, and plowing into Bitcoin. And that'll bring down the relative cost. And of course, in nominal terms, everything goes up, but the relative expense of buying a home should go down as real estate speculators and investors shift a good portion of their store of value capital into Bitcoin. So what that'll mean for equities is that PE ratios would go down over time as store of value capital migrates to Bitcoin. And then you have the return of value investing, and things should make sense again. In parallel with that, right? Of course, I think every public company, every person benefits from adding Bitcoin to their treasury. Whether that's your savings, your approach to savings as an individual, or your treasury as a company. And I think we'll see slowly the adoption of Bitcoin as a treasury asset for all companies. And so companies who are focused on delivering shareholder value through operating profits will park value in Bitcoin and benefit from that uplift. But their mandate won't become to deliver Bitcoin yield. There will be other companies who make that decision that our mandate that we're going to execute on for shareholders is to grow Bitcoin per share, and then you become a Bitcoin treasury company. So I think there's sort of a philosophical choice there for all companies of like, are you going to focus on delivering shareholder value through income statement operations, or are you going to do it through capital markets to add Bitcoin per share? And the vast majority will choose the former because it's winner take most in each capital market. I think for a pure play Bitcoin treasury company, I think there's in the US there's strategy, and there's probably room for 20 more to add some kind of value in their own way. Maybe that's 100 more, but it's not 10,000 more. And so I think most companies will have to deliver value through operations. They're conventional, traditional business models, and they can park that capital that earned value in Bitcoin and benefit from that uplift. But
Yeah, I think the other piece here is that as value investors start to look at these Bitcoin treasury companies, they're obviously going to have to think about how they treat the earnings from a traditional operating company versus the unrealized Bitcoin gains as earnings from these Bitcoin treasury companies as Bitcoin continues to appreciate. And so on one hand, you could actually argue that this is another area where Bitcoin treasury companies should be rewarded by value investors, because the income from these unrealized Bitcoin gains, you could argue, is more valuable because you could argue that it's sustainable into the future forever, at least at some kind of compound annual growth rate, and that there's less, operational or physical world risk.
Yeah, I think that's right. I think it just goes to show you how poorly understood Bitcoin is, and then even in the Bitcoin world, how poorly understood Bitcoin treasury companies are. I think, 10, 20, maybe 30% of Bitcoin holders have wrapped their heads around what a Bitcoin treasury company is, and made the distinction that it's not 2017 altcoins all over again. It's instead real fundamentals based on capital market tools to accumulate Bitcoin, which is the one thing we all agree on, like is what you want to be holding. And so obviously the value proposition of Bitcoin treasury company is this is how you hold more Bitcoin over time by leveraging capital market tools. And yeah, so I think it's a super exciting moment in time because very few people see it yet. And the fundamentals, when you dig into them, are very real. And when you compare value generation in Bitcoin treasury companies versus traditional equities, it's very poorly understood, right? Because I think the default remains, why would I pay 5x for one Bitcoin, right? Or just why wouldn't I just buy one Bitcoin instead of paying a 5x premium? That's where the discourse remains with regard to Bitcoin treasury companies, which means that people haven't wrapped their heads around, unsurprisingly, people haven't wrapped their heads around compounding growth and the incredible value generation capacity of delivering Bitcoin yield through these capital market tools. So, the net of that is that strategy trades at a 2 to 3 MNAV when it should be way higher in my book, given the amount of Bitcoin yield they're able to deliver, right? So over time, as the sort of disequilibrium between equities and bond market capital and Bitcoin, as that adjusts and kind of comes closer to equilibrium, strategy should not be able to deliver 20% Bitcoin yield every 6 months. That should drop. That'll have to drop. That's how the math will end up working. The steady state will end up being something like they deliver 5% yield, maybe 5 to 10% yield, probably more like 5 a year, right? And what are you going to be willing to pay for that? I don't know, 1.2, maybe 1.5, probably 1.5 MNAV to get your 5% Bitcoin yield a year for taking that risk and parking your capital there. And that'll be the kind of steady state future. But for the here and now, there's incredible opportunities for strategy to add Bitcoin yield, and that just also speaks to the extent to which this is not yet is out of equilibrium, right? There's so much opportunity for strategy to deliver very high yields, and for a smaller company to deliver even more. So, yeah, I think we just happen to be living at the very bleeding edge of a revolution in finance that will completely change the shape of traditional finance over the next 20 years. I gave a presentation in Vegas at a private event hosted by UTXO. And I started it by saying that, over the last 16 years, Bitcoin has been the big surprise story in global finance. There's always something that's going on. There's always some new trend that people aren't expecting. And then in hindsight, it's clear that was the big trend of that generation, really, right? And the last 16 years, it's been Bitcoin. And I think the next 20 years, it's going to be Bitcoin treasury companies and what they're going to do to traditional asset valuations as they help siphon capital away from overvalued asset buckets and point it towards Bitcoin.
Yeah, I think that's right. And one of the things you touched on there is kind of this idea of Bitcoin as the hurdle rate. And what I think we would all kind of agree here that it is the new risk-free rate globally. And what we're seeing with these Bitcoin treasury companies is, Bitcoin is
I love that phrase, by the way. It's so funny. I feel like that's been very popular lately, but I think it's also been, I guess it's sort of come in and out of fashion. Like I remember that being a thing 10 years ago too, of this is the hurdle rate by which you should measure all other investments, is the rate at which Bitcoin's CAGR has been able to deliver value growth. So yeah, I mean, it's the opportunity cost of any dollar is what your best alternative is. And if holding Bitcoin is a 29% CAGR for the next 20 years, well, that's your hurdle rate, obviously, right? Like, I think it's been funny that has become a recent talking point, but I think it's sort of self-evident. Like Bitcoin is the hurdle rate. Saylor said this 9 months ago of Bitcoin is the hurdle rate for any Bitcoin maximalist, and I think that that's certainly true. I think that should be true for more of the world, but most of the world is still trying to wrap their head around Bitcoin. Most of the world still thinks Bitcoin is a fraud. So, that's how far ahead we are.
Yeah, you could say Bitcoin is the hurdle rate, Bitcoin is the risk-free rate globally, Bitcoin is the true cost of capital. There's a lot of phrases we could use to basically say that, yeah, it is the opportunity cost of any incremental dollar allocated. And for traditional Bitcoiners who are hesitant around all this Bitcoin treasury stuff, I think they need to remember that, yeah, if you want to outperform Bitcoin, by definition, you have to take on additional risk. And that one of the risks of people that are trying to outperform Bitcoin by investing in these Bitcoin treasury companies is they're taking on operating risk because now they need the executive team of that company to execute the roadmap. But they're also taking on, to some degree, additional counterparty risk, depending on how they were custodying their own cold storage Bitcoin. And I know Mason has a custody-related question coming up. But last question from me is around this risk-free rate globally. Previously, we had a defined rate. You could look at the treasuries and you could come up with an actual knowable number as far as what your hurdle rate was. But now with Bitcoin, it's kind of whatever Bitcoin's performance is over the next period of time or going forward. I'm curious, are there downstream consequences to the risk-free rate going from something that was knowable to kind of an unknown number going forward as Bitcoin's performance is unknowable in the future?
Certainly. Yeah, and it's a whole paradigm shift, right? Like returning to free market forces rather than having those forces decided upon by shaman at press conferences. There was a scandal 10 or 15 years ago. The London interbank overnight rate, the LIBOR rate, was being manipulated by banks in London, and like all UK finance stuff was LIBOR plus. So LIBOR plus your risk rate. So that was the risk-free rate in the UK. And I remember reading about that 10 and 15 years ago, and the like chat conversations of bankers came to light where they were manipulating it. And that's the reality we've lived in a world where you have knowable rates set by people. There's opportunity for manipulation, and in a future state where you return to unknowable rates set by free market forces that are impossible to manipulate. Your trade-off is that that you don't have perfect forecastability, but the benefit is that you have free market price discovery of what the true cost of capital should be, and that I think outweighs any disadvantages of not having a very set and knowable rate.
Given that you co-founded Onramp, which is pioneering multi-institution custody that we use with our clients here at Acropolis, we're curious how you've been approaching the custody conversation now that you're working with UTXO, Smarter Web, and the other companies that you're working with.
Yeah, I think that overall, the one of the advantages of public companies is the regulatory requirements on them include an audit, an annual audit from a reputable firm, and those audits are comprehensive, right? So there's not only proof of reserves, but it's also proof of liabilities. It's a full, complete diagnostic of the health of the financial statements of a company. And at the end of the day, a company is its financial statements. So, Saylor made this point at that same event in Vegas that, somebody pressed him on, when are you going to, post your proof of reserves? And he said, we do something better. We have a Big Four audit where proof of liabilities is included. And that is the gold standard, and that's what we think is best for our shareholders and for the company, and that's what we're going to go with until proven otherwise. I'm paraphrasing, but I think that kind of gets the gist of it. And I think he's right ultimately. I think that proof of reserves is a nice to have. I think what really matters is an audit, and part of that is how you're custodying your coins and using a reputable custodian that is approved in that financial market for public companies to use. So you end up dealing with the big names, whether that's Coinbase or Fidelity or those kinds of firms. And I think there's certainly room for innovation there, but in a public company context, the innovation is adopted 10 years after 10 years of proof of concept has accumulated. So I hope that Bitcoin treasury companies shift towards multi-institution custody or some variation of best practice like that when the most trusted custodians get enough pressure on them to adopt this superior form of custody over time. And I think that the fundamentals, the realities of Bitcoin custody will eventually push things in that direction, because multi-sig is better than single sig, and multi-institution in some way, distributing your risk of responsible key parties is better. And also there's other capabilities in Bitcoin like Miniscript that I think are only just getting explored now, and as they build a 10-year track record, then custodians that public companies rely on can eventually implement those, and hopefully that's how this all develops for Bitcoin custody and Bitcoin treasury companies. Is it'll take a long time, but best practices will eventually be adopted there.
Yeah, I guess maybe a follow-up to that is, to some degree, you could expect that Strategy pays less basis points for their assets under custody than a smaller player using the same custodian, because they just have kind of more of a power to leverage that negotiation. I'm curious, from your seat at UTXO, have you thought about, or maybe something to think about, is almost treating the UTXO companies as a collective bargaining position, where you could almost say, hey, we will take all of the UTXO portfolio companies and move to a better custodian in tandem if you offer us, this rate or 10 bips less than what we're currently getting. Have you thought about kind of the collective bargaining power of the entire portfolio, which is something somewhat unique to your role there at UTXO as opposed to these one-off companies?
It's a great point. There's probably an angle there that could be explored at some point by entities like UTXO. I think that I guess a big part of it is this is such a frontier, and things are moving so fast, and the low-hanging fruit are so big that's I think the focus in the here and now, and custody, so long as it's good enough, and has sort of best practices from a public company standpoint in place, that's less of a focus. I think that could shift if investors demand it, right? So I think it's sort of an opportunity for Bitcoin treasury companies, Bitcoin treasury company investors to insist on their Bitcoin treasury companies adopting a certain form of custody that they believe is better, and could affect change in that way. But otherwise, I think that the Bitcoin treasury company industry is largely going to focus on what moves the needle the most next, and until a lot of the frontiers have been saturated, I think that multi-institution custody will probably be further down the priorities list for, based on the relative opportunities that Bitcoin treasury companies are exploring. Obviously, for an individual, it can be binary, and they can care a lot about it, and the benefits of multi-institution custody can matter more to an individual, like with regard to inheritance, which is not a concern in a public company setting. So yeah, I think we'll just continue to see how custody evolves, and frankly, individuals will probably be the primary experimenters in terms of finding more optimal solutions, proving those out, building a track record of that, and then demanding that of Bitcoin treasury companies and other entities holding Bitcoin on behalf of people.
All right, Jesse, this has been a fantastic conversation. I've really enjoyed it and appreciate your time again for coming on. For those who don't follow you already, where can they find you on socials?
Yeah, I'm on Twitter at Croesus_BTC. I'm pretty active in the Smarter Web community group on Twitter, which started a few months ago and has like 4,000 people in it already, which makes it the third largest Bitcoin treasury company group in the world. So, Strategy, MetaPlanet, and Smarter Web, which is really cool. And I think also kind of speaks to the path ahead for Smarter Web as a business to, build on that community resonance that is there. So yeah, I think those are kind of the two best places to find me. And if you want to check out Smarter Web, we've got a great analytics page on our website. If you go to the website in top right corner, there's investors. Click there and find the analytics page to see our current stats, updated with daily market data, including our MNAV, which is now, as of now, just under 4, which I think is pretty notable considering how much Bitcoin yield we have been delivering. It makes for quite an opportunity, I think.
One more plug for you. If you haven't already, check out Once in a Species and Why the Yuppie Elite Dismissed Bitcoin. I refer to it a lot because it helps explain things that people intuitively understand in the different groups of people that understand Bitcoin and don't want to understand Bitcoin. So if you haven't read that already, go read that. But yeah, thanks again, Jesse.
No, thank you. Yeah, and thanks for saying that about Yuppie Elite. Will always have a soft spot in my heart, and it reads very very well still today. Every 6 months or so, I go back and read it. But yeah, thanks for having me on, guys. This was a fun conversation, and look forward to next time.
Thanks, Jesse.
Thanks for listening to this week's episode of the show. Don't forget to like, follow, subscribe, or leave a rating on your preferred podcast platform. One of the missions of Acropolis is to educate the public on the transformational benefits of Bitcoin and Bitcoin treasuries for companies. The more engagement we get, the more efficiently we can spread this message. Lastly, quick reminder that New Foundations is for informational and entertainment purposes only, and nothing should be construed as investment, financial, or legal advice. Companies interested in Acropolis can go to acropolistreasury.com to get in touch with our team.